Hello and welcome to this short talk on whether your company should buy you a house to live in the event that the company has cash reserves, whereas you personally do not. If the company that you trade through has accumulated large cash balances, then it's tempting for the company to make the purchase and for you to live in the house that the company has then bought for you. Let's just go through the options and try to have a high-level understanding of what the tax implications of the various options would be. Option 1 would be for the company to buy the house and for the director to live in it. Option 2 would be for the company director to withdraw the cash as salary, or assuming that the director is also the shareholder, or dividends, so that it's the director shareholder that can buy the house. And the third option is for the company to lend the cash to the director shareholder so that that individual can make the house purchase. In the first option, where the company buys the house, the advantage is that there's no tax on withdrawing the cash from the company. But the disadvantages are that the company would have to pay an additional 3% stamp duty land tax on the purchase of the property. And that's 3% that's applied to the full purchase price, which may well not have to be paid if the individual who's going to live in the house buys the property themselves. There would also be an income tax on the benefit in kind, which is the provision of living accommodation for the director. Depending on the property value, there may also be an annual tax on enveloped dwellings charge, which is quite punitive. And also punitive would be the fact that there would be no private residence relief on the eventual sale of the property. Option 2 would be withdraw the cash as salary dividend and use that to buy the property in the individual director shareholder's name. The advantage of this is that it's straightforward. The disadvantage is that if the salary and dividend is withdrawn in one go, then potentially large amounts of tax and possibly national insurance would then become payable, depending on the amounts, of course. And higher rate tax might also come into play, if not the additional rate tax. Option 3 would be to borrow the cash from the company in order to buy the house. So this is a loan rather than a payment of salary and dividend. And the advantage of this is that in the long run, the tax is limited. The disadvantage, though, is that where a loan is made to a shareholder, the loan balance outstanding 9 months after the end of the company's financial year would be subject to a 32.5% tax charge, and that would be payable to HMRC at that time, and obviously that could be a very significant amount of tax. On the other hand, HMRC will repay this tax to the company as the loan is repaid in future. There is also a tax charge on the benefit in kind, where the company makes a loan to the director at below the official rate of interest, currently 2%, then that's treated as a benefit in kind and income tax and Class 1 national insurance. Class 1A national insurance is payable And this can be avoided by charging the director the official rate of interest. In summary, if option 3 is selected, the loan can be repaid by voting extra dividends to the director shareholder and using up the dividend exemption, personal tax allowances and standard rate tax band over potentially a period of years, meaning that the 32.5% tax advance that the company must pay to HMRC would then be repaid over that period of years also. In any case, you should do the tax calculations before making the decision, because every case will be different, and depending on the numbers, option 3 may be the most tax efficient, but you do need to check that. So in any case, consult your tax advisor and feel free to contact us at Tax Terrier if you have any queries at the email address below. Thank you very much for listening.